Hey everyone, welcome back to Corporate Decoder. Today, F.O.R.L.W just filed an 8K detailing a significant extension of their deadline to find a business combination, and I am seeing one red flag that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing shows the company is buying more time to merge, but the redemptions suggest a shrinking investor base. Alright, let's dive into what is happening with 4-Leaf Acquisition Corporation ticker symbol. F.O.R.L.W, these special purpose acquisition companies or SPACs, they're essentially shell companies created to merge with another company. They have a limited time to find a target, and if they don't find one, they have to return the money to investors. So on the 22nd of June 2026, the company had a special meeting with their shareholders. The main goal was to get approval to extend the deadline for them to complete their initial business combination. This is pretty common for SPACs when they are having trouble finding a suitable company to merge with. They were originally set to find a merger partner by the 22nd of June 2026, but as you can see from this filing, they got the shareholder approval to push that deadline back. The shareholders approved extending the date by which the company has to find a business combination. They can now extend this up to 12 times each for 1 month. So effectively, they have until the 22nd of June 2027 to get a deal done. And get this, the vote was overwhelmingly in favor of this extension. Over 1.8 million shares voted for it with only 900 against. This shows strong shareholder support for giving the company more runway. To make these extensions happen, the company has to put more money into their trust account. For each 1-month extension, they need to deposit $75,000. This is funded by the company itself, and it is a way to show commitment to finding a deal. Now, this is where things get interesting and a bit concerning. They also propose to remove a limitation on redeeming public shares. Basically, this means they can now redeem shares even if it pushes their tangible assets below a certain threshold. And here is the red flag. Stockholders holding a massive 893,090 public shares decided to redeem those shares. That is about 88% of the public shares outstanding. This means a huge number of investors who bought into the company initially decided to take their money back rather than wait for a business combination. After these redemptions, only a little over 121,000 shares of Class A common stock are left. This is a drastically smaller number of shares from when they first went public. When a SPAC has high redemptions like this, it often signals a lack of confidence from investors in the company's ability to find a good merger target, or that the market conditions are just not favorable for them. Think about it, if investors believed in the company's future chances, they would hold on to their shares. By cashing out, they are essentially saying they don't see much upside ahead. Compared to other SPACs that have faced similar situations where high redemptions occurred, it is not a good sign. Many of those SPACs eventually delisted or saw their stock prices plummet. For example, after many SPACs saw redemption rates above 70%, you typically see their stock prices fall by about 70 to 90% within a year of their merger. A hypothetical $1,000 investment could quickly shrink to just $100 to $300. This doesn't guarantee the same outcome for F.O.R.L.W, but it is a historical pattern worth noting. The filing also lists the exhibits which include the amendment to their certificate of incorporation and the amendment to the trust agreement. These are the documents that formalize the changes we just discussed. So wrapping up, the company has bought itself more time for a merger, but a massive number of shareholders have cashed out. This level of redemption is a strong signal of potential trouble ahead. The risk I am watching is whether 4-Leaf Acquisition Corporation can actually find a suitable merger partner that is attractive enough to stop further redemptions and create value for the remaining shareholders. My biggest concern is that the high redemption rate indicates a fundamental lack of investor confidence, which is a tough hurdle for any SPAC to overcome. What I'm actually looking for is a significant shift in market sentiment or a truly compelling acquisition target to reverse this trend. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description.